First of all, big thank you for having me on, everyone. My name is Andrew Bellingham. I'm the sales manager here at Coinify, based here in Copenhagen, Denmark. And in this short session, I've been challenged to provide some insight into stablecoins for you all. And I have been told that there are some of you in the audience with a good grasp of the digital asset landscape, whereas others are quite new to the space. So hopefully by the end of the presentation, you will all know a little bit more about the benefits of stablecoins, particularly how and why they're used to lower the barrier to entry for those looking to participate in the world of digital assets. So I want to briefly first go through how we even got to stablecoins in the first place. Right, first we had Bitcoin, a digital currency built on distributed ledger technology. And this was absolutely revolutionary for the following reasons, right? Allowed individuals to avoid banking and transaction fees when sending funds internationally. It also ensured significantly faster transaction times. And then Bitcoin also allowed the unbanked to participate in the electronic payments economy. And then lastly, due to its decentralized nature, it did insulate users and people from the failures of centralized authorities, which ensured secure access to their funds without the involvement of an intermediary or a middleman. Now, the technology behind Bitcoin, right, blockchain technology, showed us how we can establish a token of value. So what we began to see sort of pop up was tokenized versions of assets. So companies could create a digital unit of ownership, such as an asset of real estate or venture capital funds, precious metal, art, etc. The list goes on. Essentially what DigiShares can provide, right? So you can take a typically highly illiquid asset, such as real estate, you can tokenize it, right? Create that digital ownership of, or a digital unit of ownership. And then these tokens can then be bought, sold, traded on the secondary markets 24/7 as well, with extremely low transaction costs. It allowed them to be fractionalized, so you can own a portion of real estate depending on the number of tokens you have. And then this can then democratize the way the real estate market sort of works by providing a broader access to those who might have been priced out before, for example. And then also, these tokens can be used for collateralized decentralized finance lending. Yeah, the list goes on, but it's clear that the technology here is revolutionary. But what's so attractive really about stablecoins, as some of the other speakers put it as well, is that it takes the best elements from both Bitcoin and tokenized assets and then blends that with the easy to understand nature of traditional fiat currency. So this is one of the main reasons behind the mass adoption of stablecoins, because the use of these stablecoins requires significantly less understanding of the underlying technology compared to other cryptocurrencies like Bitcoin, perhaps. Right, so we can use like a car analogy for this. All you really need to know about your car is that it will reliably get you from point A to point B. You don't need to know the inner workings of the engine or the transmission system in order to use it. You just have to know and trust that it works. So the same actually applies to stablecoins here. So what is a stablecoin? Well, it's a cryptocurrency that aims to peg its market value to a reference asset. So for example, a tokenized version of a currency in this case. So when stablecoins peg their market value to the US dollar, $1 stablecoin will equal one fiat US dollar. And as Mark rightly put it as well, the stablecoin the stablecoin market rather is enormous. And it's actually grown by over 5x in market capitulation over the last year and a half. And as it stands, there are 113 billion coins that have been issued to date, which is quite interesting compared to the 28 billion, which were issued at the start of 2021. But so how are stablecoins actually useful? Well, like I said, first and foremost, they lower the barrier to entry, given their easy to understand nature. Then you have all the same benefits that we mentioned about Bitcoin on the previous slide, or on the first slide rather. Stablecoins are cheaper, safer, and faster than the payment methods available to businesses and individuals today. They enable the mobility of fiat-backed digital funds between different crypto environments without actually needing to interact with the traditional financial infrastructure. So rather than going through the hassle of, paying fees and converting your crypto assets into a fiat currency, and then, repeating that process for every trade, because that can take days depending on the bank you're using, this can now be done instantly. But they also aid in the process of price discovery, which is obviously vital for the efficient function of global markets. And stablecoins secure the value of gains of your digital assets. So, say you wanted to sell some of your real estate tokens for a profit, you don't necessarily want to hold those profits in Bitcoin, because then your profits are subject to, short-term value depreciation due to market volatility. So through stablecoins, you can actually hold that profit securely in a coin backed by the US dollar, for example. So the value of which will not rise and fall over time. And then lastly, stablecoins can connect the unbanked to the new financial system by allowing them to send and receive money digitally in an easy to understand fashion. So I think the use cases for stablecoins are quite clear in this case. Now, when we look at the stablecoin market, you can see it is an increasingly competitive landscape. And although its market share is dwindling, you can see in the graphs above that USDT, right, it's in the dark blue there, is by far the most used stablecoin in the entire crypto market. So also shown in the graph above, you can see that we have BUSD, which is Binance's native stablecoin. You have DAI, TUSD, or true US dollar. And perhaps the most important one is the second largest stablecoin on the market, USDC, which you can see is actually taking larger and larger portions of the stablecoin market share. So without going into too much detail, I would like to briefly touch on these top two stablecoins, USDT and USDC. So many of you have probably heard of the largest stablecoin before, USDT, even if those of you in the audience are quite new to the crypto world. And that's because USDT has attracted international attention due to concerns over their dollar reserves. So USDT is actually issued by a Hong Kong-based company called Tether. And despite Tether's then unproven reassurances, for years, people did question whether or not USDT was backed one-to-one by the US dollar, or US dollar in their reserves rather. So people wanted to make sure that for every one USDT that was issued, Tether had one traditional US dollar in their reserves. And as Tether was recently forced to disclose, this is not the case. So Tether released that up to 85% of their collateral is held in cash equivalents, short-term deposits, and commercial paper. Now, the remaining 15% is in the form of secured loans, corporate bonds, funds, precious metals, and other tokens, for example. But when you take that 85% and you double click on it, you look at the graph to the right here, you see that over 57% of that is actually unspecified commercial paper, which is a form of corporate debt. So to make matters worse, Tether also declined to identify the borrowers of the loans and or the collateral that was backing them. So this worried people, and rightfully so. Especially when this was released, there was no mention of any independent review by an accounting firm, for example. So now we have USDC, right? And USDC is actually issued by a US-based company called Circle. They were founded in 2013, and they've raised over $770 million from big names such as Goldman Sachs, Bitmain, and Digital Currency Group, for example. And USDC has become significantly more popular in recent years because it positions itself to be the more regulated, more audited, and the more trustworthy stablecoin on the market, right? In a time where confidence in USDT or Tether is on the decline. So, I mean, unlike Tether, you can see here that Circle's blend of reserves is quite different, with a greater focus on cash and cash equivalents and a smaller share on commercial paper, right? Only 9%. And proponents of USDC view the stablecoin's larger allocation of cash and cash equivalents as an indication of Circle's capacity to support large-scale USDC redemptions in the event of a crisis. So really, it's their financial and operational transparency which allows them to really stand out in the stablecoin market. And they're also audited by Grant Thornton, which is worth noting here. And they release reports on their US dollar reserves every month, which is great. And it is arguably because of this that they've landed some of the largest partnerships in the industry, such as with Visa and Coinbase as well. Now, we know how assets can be tokenized now and all the benefits that go along with that technology. But say you've decided you would like to buy a piece of tokenized real estate through a company like DigiShares, for example, and you've decided that you will take the most straightforward route and buy this token with a safe and reliable stablecoin, like USDC, for example. You do still need a way to buy your USDC with traditional fiat currencies, like the US dollar, for example. And this is where regulation can typically pose a bit of a challenge, right? The cryptocurrency market, as I'm sure most of you are aware, is a widely unregulated market. But the one way in which authorities aim to regulate the space is actually to keep a stern eye on the entry and exit points of the crypto market. So what does this regulation entail? Well, it means that the identity of the individual entering or exiting the crypto market needs to be recorded for anti-money laundering, anti-terrorism financing, screening of politically exposed persons, or even for running sanctions checks, for example. So like in the EU, they enforce the AMLD5 regulation, the Anti-Money Laundering Directive 5. So this can be quite a lot to think about for the average Joe who's just looking to buy a few €100 or dollars worth of USDC. So what is the solution to this? Well, this is where Coinify comes in, thankfully. We do provide the most compliant access into the crypto market without compromising the ease of use from a user's perspective. We were established in 2014, right here in Copenhagen, Denmark, and users and businesses typically rely on us at Coinify for our compliance-first fiat to crypto gateway, or on-off ramp, as Mark referred to it as. So this means that users can buy an array of cryptocurrencies with their Visa or MasterCard, debit and credit cards, as well as bank transfer as well as Apple Pay. So, which again, are just about lowering the barrier to entry for the average person looking to participate in the space. This is something we've been doing for 7 years now, and over that time we have grown that user base to over 40 million, and we are fully compliant in 180 countries, which means that all AML and KYC regulations mentioned on the previous slide are fully adhered to. So the user really doesn't have to think about it. So how does it work? Well, number one, the user must select their desired fiat currency and their cryptocurrency of choice. And then following that, the payment methods are presented. The user then completes a one-time KYC, which we do with every single user that enters Coinify's services. But that just means that they have to select their country of residence, they take a quick selfie, and then a photo of their identity document as well. So from there, the whole KYC AI mechanism does the rest, which means that it actually only takes 2 minutes for each user to complete the KYC. So we really are just trying to make it as streamlined and quick as easy as possible for every user. And then once you have officially bought USDC through Coinify, the USDC will be sent directly to your platform of choice. In this case, it might be your DigiShares account. So it really couldn't be easier than it is right now. Yeah, I hope I've provided some useful information here about the stablecoin market, as well as the technology and use cases behind it. If you'd like to learn more, about the specific use cases even for buying crypto with fiat as a business or individual, more than welcome to drop me an email at afb@coinify.com. And we can also do like a personalized Q&A there if you'd like as well. But thank you.
Yeah, I have gone through the Q&A, and I think there are several questions. I think most of them are better for the fireside chat, but there is one I believe is directly to you, and that is from DL. Is pegging a coin to fiat a transitionary solution? Will there be a necessity for a stable coin once mainstream cryptos become less volatile?
I would still argue yes. It's, again, if you don't want to have to pull your funds out into traditional fiat currency, you do need to secure the dollar value of your gains. Yes, maybe Bitcoin will become more stable as it grows in market cap, but at the end of the day, you will have stable coins being the more likely go-to solution, just because they will be more stable. And then later on, when algorithmic stable coins become more and more popular, that value is really pegged to $1 exactly, without the need for collateral either. So I think that's more the direction we're going to go in, as opposed to just not using stable coins at all.
Okay, very nice. And then there is just a comment, and that is excellent.
Thank you very much, whoever that was.
Yes. That was it then. You are joining us in the Q&A in not so long. So see you there, and thank you very much for your presentation.
Thank you very much.